It's the first Monday of the month, 7:32 in the morning. You're standing in your kitchen, pouring a cup of coffee, when your phone vibrates on the counter. Dividend payment received, $666. Not a paycheck, not a tax refund, not money from selling anything. Just another monthly deposit that quietly arrives while your coffee is still steaming. Now imagine seeing that notification every single month. Whether you're working, traveling, sleeping, or taking the day off, the payment keeps showing up because your investments are doing exactly what you bought them to do. But here's the real question. Is that actually realistic, or is it just another passive income fantasy that sounds amazing until you look at the numbers? Hey, I'm Brian, and I spend way too much time thinking about the difference between investments that look good on paper and investments that people can actually stick with for decades. Today, we're going to break down exactly what happens if you invest $100,000 into some of the best monthly dividend stocks and income funds, why the math is more realistic than most people think, and why the biggest advantage has almost nothing to do with the dividend itself. And if you're interested in building wealth without relying on hype or financial shortcuts, consider subscribing. Every week, we break down the numbers most people never stop to calculate. Whenever someone asks what to do with $100,000, the advice is almost always the same. Buy a broad market index fund. Ignore it for 30 years. Focus only on total return. And to be fair, none of that advice is wrong. Historically, broad market investing has built enormous wealth for millions of people. The mathematics are difficult to argue against. But there is one problem that almost nobody talks about. It assumes you behave like a spreadsheet instead of a human being. Real life doesn't happen once every decade. It happens every single month. Your mortgage is monthly. Your rent is monthly. Your electricity bill is monthly. Your insurance is monthly. Your salary usually arrives monthly or every 2 weeks. Your financial life operates on a monthly rhythm, but traditional investing often asks you to wait months for dividends or years before you feel rewarded. That creates a psychological gap that quietly destroys motivation. You keep putting money away, but nothing feels different. Eventually, people stop contributing, panic during market crashes, or convince themselves investing simply is not working. That is because human beings are wired to repeat behaviors that provide regular reinforcement. We struggle to stay motivated when rewards feel distant or invisible, even if we know the long-term outcome is better. And this is exactly where monthly dividend investing changes the game. Instead of asking you to wait endlessly for proof that your money is working, it creates a rhythm that matches the way you already experience your financial life. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Let's slow down and actually run the numbers, because this is where most conversations either become wildly unrealistic or painfully vague. We'll stay conservative. Imagine you have $100,000 available to invest. Now suppose you build a diversified portfolio of quality monthly dividend investments. That could include carefully selected real estate investment trusts, income-focused exchange-traded funds using covered call strategies, and established income-producing companies. Instead of assuming some impossible return, let's target an annual dividend yield of 8%. That is not guaranteed, and it is certainly not risk-free. But for a diversified income portfolio, it is a realistic figure that many experienced income investors aim for, rather than chasing extreme yields. Here's what that looks like. $100,000 multiplied by 8% equals $8,000 in annual dividend income. Now divide $8,000 by 12 months. You arrive at approximately $666.67 every month. That number matters because it transforms investing from something abstract into something tangible. $666 every month could cover your utility bills. It could eliminate a car payment. It could pay for your health insurance. Or, if you do not need the income today, every single dollar can be automatically reinvested into buying even more shares that generate even more future income. Notice what we are not doing. We are not assuming your portfolio doubles every few years. We are not promising overnight wealth. We are not pretending every investment will perform perfectly. We are simply asking one question. What happens when your money consistently produces cash flow every month, instead of sitting quietly and hoping you remain patient enough to wait decades before feeling any reward? Now, if you've been investing for a while, you are probably thinking about the biggest objection to this entire strategy. Wouldn't you make more money by focusing on growth instead of dividends? That is a completely fair question. In fact, over long periods of time, many broad market index funds have produced higher total returns than dividend-focused portfolios. If your only goal is maximizing your portfolio value several decades from now, growth investing deserves serious consideration. That is not something dividend investors should ignore. But notice what happens in the real world. The biggest threat to your financial future usually is not choosing an investment that earns 1 percentage point less each year. The biggest threat is abandoning your plan altogether. People panic when markets fall by 30%. They stop investing after a year because they feel like nothing is happening. They sell during recessions because watching a portfolio lose value without receiving any cash flow feels unbearable. That is why this debate is often framed the wrong way. It is treated as a competition between two investment strategies, when it is really a competition between two human behaviors. The best portfolio on paper means absolutely nothing if you cannot stick with it through fear, boredom, and uncertainty. Monthly dividend investing does not necessarily win because it always produces the highest mathematical return. It wins for many people because it encourages consistent behavior. Every monthly payment is a reminder that your investments are producing something real. That steady stream of income reinforces patience instead of panic. Instead of wondering whether your money is doing anything, you see evidence of progress arriving month after month. And over a lifetime, the strategy you consistently follow often beats the strategy you constantly abandon. Think about it this way. Imagine two neighbors. The first buys a young calf. Every day, he feeds it, takes care of it, and hopes that years from now someone will pay much more for it than he originally did. Until that day arrives, the animal produces almost nothing for him. The second neighbor buys a healthy dairy cow. Every morning, he walks into the barn, fills a bucket with milk, and goes about his day. The market might decide tomorrow that cows are worth less than they were yesterday, but unless something has fundamentally changed, the cow still produces milk. That is the difference in mindset. Growth investing often asks you to focus primarily on what you can eventually sell. Dividend investing encourages you to focus on what your assets can produce while you continue owning them. Of course, real companies are not cows, and dividend payments are never guaranteed. Businesses can cut dividends if profits weaken, but the mental model is powerful because it shifts your attention away from constantly checking prices and toward evaluating the cash-producing ability of the businesses you own. When your investments become income-producing assets instead of lottery tickets, you stop obsessing over every headline and every market swing. You begin thinking less like a trader and more like the owner of a business that sends you a share of its profits every single month. Now let's talk about something that scares almost every investor: market crashes. When stock prices fall by 20, 30, or even 40%, most people instinctively want to stop investing. It feels like throwing money into a hole, but this is where the mechanics of monthly dividend investing become surprisingly powerful. Imagine your portfolio is still producing approximately $666 each month in dividends. Instead of withdrawing that money, you automatically reinvest every payment. Now suppose the market drops by 30%. Those same $666 are no longer buying shares at yesterday's higher prices. They are buying more shares because everything has become cheaper. Without making an emotional decision, without trying to perfectly time the bottom, without convincing yourself to buy the dip, while everyone else is panicking, your portfolio quietly buys more ownership every single month. When markets eventually recover, those additional shares begin generating even more dividend income than before. The downturn becomes an accelerator for future cash flow, rather than just a painful headline. That said, this only works if you own quality investments in the first place. One of the biggest mistakes new income investors make is chasing the highest dividend yield they can find. A stock paying 15% often is not a hidden opportunity. More often, it is a warning sign that investors expect trouble ahead. The share price falls faster than the dividend has been reduced, making the yield appear unusually high. That is known as a yield trap, and many investors discover the trap only after the dividend is cut. Income is only valuable if it is sustainable. So what might a practical $100,000 income portfolio actually look like? One simple approach is to divide it into 3 different jobs. The first $30,000 goes into high-quality real estate investment trusts. These companies own income-producing properties like apartments, warehouses, medical facilities, and commercial buildings. By law, Many real estate investment trusts distribute a large portion of their taxable income to shareholders, making them natural income generators. The next $30,000 goes into carefully selected income-focused exchange-traded funds that use covered call strategies. These funds are designed to prioritize consistent cash flow over maximum growth, adding another stream of monthly income to the portfolio. The remaining $40,000 goes into high-quality dividend aristocrats and investment-grade corporate bond funds. This portion adds stability, diversification, and companies with long histories of rewarding shareholders while reducing dependence on any single income source. No single investment has to carry the entire portfolio. Each bucket has a different role, but together they work toward the same objective, producing dependable monthly cash flow while managing risk through diversification. When people hear about investing $100,000, they often think the goal is becoming rich. I think the real goal is something much more valuable: control. Imagine opening your bank account every month, knowing that part of your bills is covered before you even clock in for work. Imagine losing your job and knowing your investments are still producing income. Imagine reaching retirement and relying not only on savings but on assets that continue working for you month after month. That is what you are really buying. Not just dividend payments, not just percentages. Peace of mind. The confidence that your financial life depends a little less on your next paycheck and a little more on assets you already own. And remember, you do not need $100,000 to begin thinking this way. The psychology starts long before the portfolio reaches six figures. Even $100 invested into a quality dividend investment or a fractional share begins the same habit. It changes the question from, how do I earn more money? To, how do I own more assets that earn money for me? Take that first step today, because the sooner you stop thinking only like a worker and start thinking like an owner, the sooner your money can begin working alongside you instead of waiting for you.